All right, everybody, it's Saturday, August 16th, 2025. Our episode begins with our headline, PPI Isn't What It Seems. I brought up on Thursday's show that PPI came out very hot at 0.9%, and I was curious why gold actually sold off. In a nutshell, we have a quote from the BLS report. Over half of the broad-based July increase is attributable to margins for final demand trade services, which jumped 2%. Trade indexes measure changes in margins received by wholesalers and retailers. So nothing to do with input costs, but more like just wanting to charge more and get more profits. Another notable piece of the PPI that I found very interesting, portfolio management was brought up a lot through the report, rising 13.3% year over year. So the inflation is more in-house within the United States, not really having anything to do with tariffs. The reason this allowed gold to drop off a bit is because the market started pricing in less of a chance of a Fed cut in December. The Fed is expected to not get too dovish is the main point here. While there are still a lot of things uncertain, a lot of uncertainty regarding tariffs, there's a little bit more certainty when we see what's going on within the country. So in a nutshell, that's what had happened, and that is how markets responded and why they responded in the way that they did. I wanted to mention onto our next topic, the options expiry was on Friday. I think this had partly to do with MSOS going down, so everybody that had calls expiring yesterday, including maybe some of you. Remember, these institutions are the ones that are selling these contracts, and they want to make sure that they come up as worthless as possible. They don't want you to win when you're buying contracts from them. So they'll push markets around to wherever they want them to go. Monday and Tuesday of next week should give us a better sense as to where Mr. Market really wants to go from here. Friday we had retail sales report come up, and it was reported as being strong, but it's also showing that most of the spending is in upper, middle and upper class spending. This is while lower earners are really struggling here, with stagnant wages and prices going up, reduced hours, people giving up on looking for jobs. It's still, getting worse. But hey, as long as the stock market keeps going up to new highs, upper and middle class people will still feel wealthy enough to keep spending. So the music still plays as it stands. How long the music will keep playing for, I guess we'll see. Next headline, are there too many bears for the market to get bearish? If you're watching this video, it's likely that you watch other people's videos, maybe CNBC, maybe you follow Financial Times. Point I'm trying to make here is I'm hearing a lot of people feeling very bearish right now, thinking like, how could we not be at top here? And I'm questioning, okay, well then, are there too many bears for the market to actually get bearish? These aren't new charts. They've been around for a while, but they're suddenly coming on to pretty much everyone's radar. And if you haven't heard them, I'm going to walk through them real quick. We have the Buffett indicator. We're at two standard deviation above the historical trend line on the Buffett indicator. It represents the percent ratio of market value to GDP. So what's the cost of stocks compared to the productivity of the United States? And as it stands, back in March, we're actually higher than this now. This is, again, these are not even new charts, but they're suddenly making the rounds in the internet. Back in March, we were at 200% ratio of market value to GDP. Also around this range in 2022, and before that, the dot-com bubble. And you can see what happened after the dot-com bubble. We got to a negative one standard deviation below this level, almost to a 2. Look how far that is, by the way, from where we are today if we were to get back down to a negative 2 standard deviation. I said on the show before, I don't think it's impossible for the stock market to drop as much as 85%. It's not an exaggeration. This chart has also been making the rounds on everybody's video, so I wanted to bring it up. We are higher than we've ever been in history when you combine the trailing PE, forward PE, CAPE ratio, price book ratio, etc., to GDP. The stock market has never been higher, but remember, this report was all the way back in January. Since then, the stock market has actually gone up another 6%, so we're higher than this right now. And another chart making the rounds lately, the weighting of the top 2 holdings of the S&P 500 has never been higher. So 15% of the S&P 500 now is only 2 companies, NVIDIA and Microsoft. The danger here is the amount of wealth that people think they have packed into these companies, not in the form of healthy investment, but in assumed growth. This is speculative. Any amount of growth priced into any security is speculative. It's not possible to properly price growth, which is why it can go up enormous amounts and down enormous amounts. And when you have 15% of the entire S&P 500 in 2 companies that have a lot of growth priced into them, it shows you how risky the S&P 500 is, how much speculation is priced into the stock market, generally speaking. So it was considered obscene for that to get all the way up to 9% back before the dot-com bubble with Microsoft and GE. It also seemed problematic when Chevron and Walmart together represented an entire 7.7%. Also in the mid-80s, 11% of IBM and T-Mobile. And 2025 says, hey, you think those are bubbles? Hold my... Well, you get the idea. Now, while it seems like bearishness is getting popular, it's not getting priced into markets. And the 2 places I like to look to see what's going on to determine this is, number 1, the put to call ratio. If this was extraordinarily high, I'd say, okay, yeah, there's maybe too many bears on board and the market can keep pumping higher. Just to zoom in real quick where we are, this is not extraordinarily high in the put to call ratio. There's not tons of puts being bought right now compared to calls. Another little pattern that I noticed in the put to call ratio, when you have higher lows, it often leads into some sell-offs. By the way, the blue line, if you're not aware, is the put to call ratio, and the orange line is the price of the S&P 500. So when you have higher lows, it oftentimes goes into a corrective territory in the S&P 500. And I just noticed, since February of 2025, we've been putting in higher lows in the put to call ratio. So it could be a sign that maybe we really are at a top here. I'd say there aren't too many bears yet. I also want to bring up the skew index. This represents the pricing of far out of the money option contracts. Overall, the skew index, interestingly, has been high and grinding higher. I wanted to also point out that before the dot-com bust, we had an ultimate peak actually in the end of 1998, interestingly, before the dot-com bust. Also, before the great financial crisis, we found its ultimate peak actually in the beginning of 2006. This was a while before people realized that problems going on. I wanted to mention that we recently had an all-time high in February, peaking intra-month to 183.78, and since then coming off a bit. Main point is in the media, there seems to be a lot of bears, but not in the price. And so my answer to this is no. I think the markets could get very bearish very quickly. But remember, guys, that's just me and my crystal ball. Community topics. What moves, if any, did you make today? I mean Friday, of course. And why? Robschild is continuing to buy more HYG puts. HYG is a fund that holds junk bonds, and they can only get so expensive. The most expensive they've ever gotten in history was right before the great financial crisis, where the spread between junk bonds and treasuries was only 2.46%. It's very strange and complacent and odd and worrying whenever it's below 3%. And lately we've been finding higher lows in this. We did have a spike in April. I am expecting a larger spike very soon. And as I've said on the show a bunch of times before, HYG has a ceiling. It can't, credit spreads can't go negative to treasuries. And if all rates go up, the value of HYG goes down, because when yields go up, debt securities go down automatically. And like I keep saying, if the whole curve starts dropping, if all yields start dropping, it's probably because things are blowing up, and that means credit spreads are blowing out, which means HYG goes down no matter what. So while it's impossible to know how high the S&P 500 or the NASDAQ can go, something like HYG can't keep going up. It can stay elevated for a long time, but it can't keep going up, which is why HYG puts are such a beautiful way to get exposure to the downside if it comes. Coming up, like I said in the last show, there's not a ton of data coming out next week, but we always have the tariff updates, geopolitical things going on, a lot of stuff with Russia. I'm sure you heard in the news today. The talks between Trump and Putin sounds like they're going okay. And I keep having my eye on the weekly jobless claims coming out on Thursdays. Thank you for watching, subscribing, commenting, and supporting the Robschild channel. No changes to my website or my daily reminders macro views. I think it's as important as ever to understand all of these things right now for where we are with the valuations and everything. Crystal ball readings remain the same, and the Robschild portfolio remains the same. Onto the charts. Seems like this is on everyone's radar right now. Yet, by the prices of everything, it seems like the market's completely ignoring this so far. We do have a major divergence between the S&P 500 and the NASDAQ too. The price of it and the RSI. Look at this. Look at this divergence here. RSI making such a clearer lower high, while the S&P 500 finding a higher high. Big sign that this can reverse very easily. Next up, Bitcoin. I'm still amazed by this fake out. It looked like a breakout, and it reversed down so hard on Thursday, with continuation into Friday and sort of going sideways here. It's starting to look like it may be developing a bear flag. I'm still short Bitcoin. As a reminder, why are you short Bitcoin? Robschild, well, if you connect the 2017 highs to the 2021 highs to the 24-25 highs, we're above it right now. And usually when we get to that line, well, in 2021, we dipped down, we hit it again, and then dropped by 77%. And then in 2025, we hit it, we dipped down, and then we're right back at it. I'm thinking if the same thing happens that happened in late 2021 going into 2022, we may get a move down by 77 or even much larger percent down. Remember, 2022, this wasn't even a recession or a depression. So considering how overvalued everything has gotten, I don't think Bitcoin's going to hold up here. I know how easy it is to confuse something that is performing really well and at a very high price with safety. It feels so safe, and it's the opposite. It is the absolute opposite of safety. The amount that Bitcoin can potentially drop to the dollar is absolutely enormous. And so that's why I'm still short Bitcoin. Again, August and September being infamously frothy. Actually, I recently saw someone talking about seasonality. Actually, from right now, the middle of August, typically, we get a spike in volatility, and it looks like, well, it hasn't started yet. I think it will probably start on Monday. It seems like a lot of people know this stuff, but it's not being priced into the markets at all. Not anticipating it. So, eh, next week I think will probably be fairly crazy, but we'll see. I mentioned on Friday or Thursday rather, that we had a decent move up by 6 basis points in the 10-year Treasury note yield, and I said, is this going to have follow through on Friday? Yeah, it did. So it looks like from, your basic trend line analysis, taking the April low, connecting to July low, looks like we're very likely to reach up. We have actually a confluence of trend lines. We also have the May highs with the July highs connecting right here. So it's almost acting like a magnet, like it wants to go here. It'll certainly have a lot of resistance here. Traders better than myself are expecting it to get rejected and go lower from that point. The 2-year Treasury note yield still seeming fairly stable, rising only by, what is this? 2 basis points on Friday. And pattern-wise, still within a bearish flag. I said on Thursday, and I'll repeat, the dollar doesn't seem to know really what to do here from my standpoint. I've been very consistent about going against the crowd, against the narrative, suggesting that the dollar is falling and going to keep falling from here. Recently we've experienced higher highs and higher lows. If you gave me this chart and didn't tell me what it was, I'd say, hey, maybe this is building a base here. It doesn't look bearish to me. Crude oil nervously falling a bit. We had Friday drop to $62.32 a barrel. Remember, the retail sales report is not because everyone's doing so well, and oil is confirming that. Copper with a PhD in economics still going sideways here. As is with the price of anything, you can't just go sideways forever. And actually, the longer you go sideways, typically the bigger the breakout. And after a break like this, the pattern alone looks fairly bearish on copper. This is one of the most interesting charts to be following right now, and I can't wait to see what's going to happen next. Again, the not bullishness of gold on Thursday and Friday is attributed to the Fed being appropriately hawkish. I say it all the time, but I still think gold is in a major bubble. How much more expensive can gold get? Are we going to get to the point where the piece of gold jewelry in your jewelry box is, worth a house all by itself? At some point, the market needs to wake up to realize that gold is not infinitely valuable, and that you have to consider the price comparisons of gold to copper to housing and to crude oil primarily. Those are the 3 big ones, and we've never seen gold this expensive. Feel like I'm literally the only person on the internet saying that gold's in a bubble right now. And it makes me that much more happy to be short gold. But who knows? Maybe your wife's gold earrings will buy you a whole apartment complex within, a few years. I don't know. I do have a lot of new viewers on the show, and so if you don't know how to figure this out, longtermtrends.net, might as well throw it in here. I've showed it on the show lots of times, but it's worth talking about it again. This is the home price index to gold ratio. It says how much gold does it cost to buy a house. When it's very low, it means that it doesn't take as much gold to buy a house as it normally does. And the higher gold gets, the closer we get to all-time heights of gold compared to home prices. I'll add that home prices have been cooling off a little bit lately, which can drive this lower if gold stays where it is. Moving on, I said on Thursday with a high PPI report, I noted how the 5-year and 10-year break-even inflation ticked up a little bit, and then on Friday we reversed right back down to where it was on Wednesday, both on the 5-year and the 10-year. Well, the 10-year not getting to Wednesday's rate, but notably not continuing higher. Last chart of the day, just to remind everybody, the 10-year minus 3-month treasury, it can't stay at zero forever. When you lend out your money, for a longer period of time, you need a higher rate of return, period. Because the longer amount of time that exists, the more potential risk there is in that time period. The Federal Reserve can make it so that you can get more money for your money by lending it for a shorter amount of time. That's why this goes below zero, 10-year minus 3-month. When we come out of it, we go into a recession every time. And I still am just flabbergasted by the fact of how deep and long this inversion has been, 2.5 years. And then since then, after the 2.5-year inversion, we have been coiling up. Sorry, here. Let me get this right. We've just been coiling around zero, up and down, undecided whether the Fed is strangling the economy or not. If you did not have dates on this chart and showed this chart to someone 10 years ago or so, they would think the world was on fire. And yet the stock market has never been happier. I think this will all end sooner than later, especially, like I said earlier in the show, there aren't too many bears. That's all for today's show. Hope you enjoyed. Thank you for watching and see you next time. Robschild.